I'm with Greg Welborn today from First Financial Consulting, and today we're going to go over a couple of fears, concerns that clients have about the market.
Real concerns?
Real concerns. These
Didn't
are
make these up.
real emails from clients that were sent to Greg. So today we're
Perfect.
going to answer a few of those. So to start, we have an email from a Cheryl, and Cheryl says, Greg, I'm really concerned about my stocks. The current stock market seems to be obsessed with AI. I'm worried about the short term when massive layoffs could tank the economy. Could I handle it if the market takes a nosedive?
It's a great question. And, you shared the names with me ahead of time, so I kind of have the sense of where each client is, because that really does matter when we address this issue. Now, for both of them, and we'll get into the other one a little bit later, but the fact that people have concerns is legitimate. I don't want anyone to think that, gee, they shouldn't be scared, even though we're going to tell them, look, you will survive this. There's a way to handle concerns about the market constructively as opposed to destructively. But it's very real. We've lived through very difficult times almost all of my life. We're living through difficult times now because there's always some economic event that seems to be just over the horizon, or there's some political event, or there's a hiccup, or fill in the blank. The point is, we may never know what the name of it is, and we may never know how close it is, 1 week, 1 month, but we live in turbulent times, and we have been for, let's call it, half a century or more. We've anticipated that. That's normative in the sense that it's going to happen, has happened, but it's also a little earth-shattering because it's not normative to clients, and they don't have to worry about this stuff.
Sure. So, in other words, it doesn't really matter whether it's AI or something else.
No, it doesn't. The point is there's some disruption, that kind of coin a term that's now used in the technology, era. We know what everyone seems to know what a disruptor is. As an appearance of some entity, some firm, some person in an industry, and the whole way the industry was going to be doing things just got disrupted because some guy comes in and says, hey, we can do it better, cheaper, faster, and we can throw lots of people out of work, or we can shut down this plant and open up something here. But that term, although it wasn't used in history, was in fact a very, very good descriptor because everyone settles in, whether it was pre-World War II or in the beginning of the Cold War or when theoretically we won the Cold War. People settle into a new norm. And then there's something that disrupts that norm, and the markets reflect that. Things start going crazy. The news cycle starts to pick up on that. The old expression, if it bleeds, it leads. What it means is the news is going to go with something that really sells copy, sells advertising. People want to pick up, they want to tune in. So it's going to be hyperbolic, it's going to be exaggerated. There's disruption, there's concern, there's worry. The names change. It's AI, it's a currency manipulation, it's the start of a regional war, it's a new tariff, it's a new tax consideration. Congress is debating something that everyone thinks this is going to be stupid if it passes. All of those are legitimate. They've all happened in the past. They will happen in the future, and some of them are happening right now. And they cause concern, they cause disruption. I'm never going to know the name, but we know that they're going to happen.
Sure, but couldn't you also say that AI being so brand new, there is reason to avoid stocks or positions that include those in whatever portfolio exists?
Great question. I'm going to tweak it a little bit. Are there reasons to avoid specific positions in AI? Absolutely. Should you avoid AI in general? No. And I'll use two analogies, both about the same time, a little bit separated. If you go back to the early part of the 20th century, the 1900s, electrification of the United States was occurring. It was the wave of the future. We were going to move off of oil, off of steam in the factories. We're going to move to electric power. Okay. Everyone said, oh, electricity is going to be the wave of the future, electrification of the countryside, the rural areas, the cities. We got to jump on this. And there were, catch me by surprise a little bit on this specific question. So let's say there was 20, 25 electric companies all competing to do this. People were right. Electrification was going to be the new norm. Electrification was going to be a growth industry. Of those 20, 25 companies that were in existence at the time that you could have invested individual positions in, individual stocks, guess how many stocks survive to today? I think it's 3. So if you took a position in the New Jersey Light and Power Company, you ran the risk that it was going to lose because it was the New York Power Company that was going to electrify that part of the country. But if you could broadly have invested in electrification, you would have benefited. Same thing with AI. I have no idea which AI company, which chatbot, ChatGPT, Gemini, whatever is going to win, but we do know it does promise to revolutionize, disrupt, to make things more efficient, to help both producers, distributors, service people, and consumers. Okay. So invest in AI, yeah. Try to pick an individual position. Don't even begin to try to do that. You'll lose. Odds are.
What about mass layoffs? Because that's another question that Sally gave us. She said, every time I watch the news, something bad is happening and I worry that I'll lose my money. I'm happy the portfolio is doing well now, but I hear all these deteriorating conditions, layoffs, drops in business everywhere, mergers to save money, alienation of global partners, and the list goes on. What would you say to Sally in terms of all those different factors that maybe appear in the media to be bad news about the economy, or the economy's tanking, people are losing jobs, so on and so forth? How would you advise someone to structure a portfolio? What advice would you give me if I came to you and said, hey, these are my concerns, I'm scared?
All right. Now, Sally and Cheryl are both in different phases. So as we get into the question about, well, how do you handle that in their portfolio, we're going to have different answers. But for bringing up right now what her concerns are, and she's named something very specific, layoffs, okay, are going to be a problem for the industry in which there are layoffs. But let's think about what actually happens with the money. Okay, the reason that there is a layoff is because people, for some reason, aren't spending the same amount of money in buying that company's product. So they're going to lay off some people. But where is the person who was buying from that industry buying? They've done something with their money.
Sure.
So we look at industry A and we say, oh my gosh, there are going to be layoffs in industry A. Well, it's usually because someone has shifted and they're now starting to increase spending in industry B. What never captures in the news cycle, again, because of this, if it bleeds, it leads, let's show the bad news. It's also easier to show up at a factory that's letting people, walk out with pink slips. This is white, but they're walking out with pink slips. It's like, I'm laid off, and you count 1, 2, 3, 200, 400, 300. Much more difficult to go find, well, where is the increase in employment happening? Where is Sally or Susie or Cheryl or Bob or you? Where are you spending your money? You used to be doing it in industry A. Now you're doing it, and maybe it's not just industry B. It's a little bit in B, little C, little D, little E. You can't possibly go with your microphone and your camera, if your channel, your ABC or NBC or whatever, and go find where that's occurring. But layoffs in and of themselves mean that money is being spent in a different direction. It's not in and of itself bad news.
Okay. Let's talk about things not to do then. Obviously, panic selling, something not great.
No.
So what information or what advice would you give to someone who was scared right now?
Well, we kind of touched on it to begin with, and that is to realize that your fear is normal, but realize you're afraid of something that has happened, is happening, and will happen. So the second thing, I guess, to do is anticipate it. I would say work with an advisor that can help you anticipate it. Know that you're going to have some disruptions. Lord willing, you live long enough, you're going to see disruptions. You're going to see the market sell off 20% or 30, or maybe even every once in a while a 40% sell off. You anticipate that in your structure. You say, I'm going to create an investment structure that doesn't say, oh, it's rosy, it's going to be 7% every single year, clickety, 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 clickety. We can say you're going to earn 7% on average over a long period of time, or 8 or 9 or 6 or 5. Those are all different places in the risk threshold. But we can say you're going to earn an average rate of return, while at the same time saying you're not going to earn that average every single year. There's going to be highs and be lows. Anticipate that. Make sure that the structure tolerates the lows and the highs.
So what if I'm retired, back into my retirement, and I need this cash now, and I'm withdrawing from whatever positions I have? Do you change the tactic, or does First Financial change the tactic when it comes to those people later in his retirement, opposed to someone who is either nearing retirement or just in retirement?
Yes, but not at the time that you think we're going to do it.
Okay.
Okay. We're going to change the tactic not, if you will, the strategy, the tactics. We're going to change the tactic as we get nearer to the phase, the change, if you will, from accumulation to withdrawal. Most people are going to go through very broad, relatively long phases. The longest one usually is accumulation. From when you first get the job until whenever you're going to retire, you're kind of in maybe the debt payoff stage when you're really early. But at some point, you're accumulating. You're accumulating home, real estate value, you're accumulating some savings, some checking, some investments, some IRA, some 401k, accumulate. And then there's this point when that phase ends. And usually it doesn't just end abruptly. Most people have a sense of, I want to retire at 62 or 65. We know that phase is coming. That is a different phase. There are going to be different tactics. So as we get close to that transition, we start talking with the client about, all right, we've worked out a strategy with you. We've worked out an allocation strategy. We know what rate of return you need for your plan to work. And your plan has to go from whenever you start it, okay, whether it's 20s, 30s, 40s, or 50s, not just up to retirement, but it has to go through retirement. Because most people, in this country at least, will probably live 20 to 22 years in retirement. That's enough time for inflation, even at the post-World War II norm of 3%, to whittle your purchasing power by half. So you can't just go into retirement with a different strategy. Oh, go get conservative. Oh, go sink everything into bonds and still keep up. You need to have a portfolio structure, an allocation structure that is going to grow you through the accumulation phase and then is going to continue to grow you in the withdrawal phase. The change in tactic, again, we've got this structure, whether it's a 50-50 between bonds and stock, 60-40 between bonds, whatever this is, this broad strategy, okay? In the accumulation years, we would put more of the bond portfolio into longer-term bonds and less into shorter-term bonds. When we get into the withdrawal phase, we can keep the same percentage that's in bonds, 50%, 40%, whatever it is. But instead of having a heavy weight to long-term bonds, we're going to have an equal weight-ish between long and short-term. In fact, what we're going to do, you had a question?
Okay.
Okay. In fact, we're going to take a look at what are the planned withdrawals that are going to occur in this withdrawal phase. Hopefully, we're going to keep those at, let's say, 4, 5, maybe 6% of the portfolio value at a max. So if we can anticipate there might be a 3-4 year period of time when the market's down, we do not want to have to liquidate investments when prices are down, depressed, in order to give somebody the cash flow, the withdrawal they need to live their life in the withdrawal phase. So I want to make sure that I've got into the short-term bond portion, maybe 3 or 4 years worth of the planned withdrawals. So I have a place, the short-term bond portion, to go for 3 to 4 years. I can withdraw money from there. Stocks have gone down. I can keep withdrawing, and then let stocks come back up. I never have to touch the stock portion when prices are depressed. If we do it right, we build in enough time so that the stocks can come back up, and then we can backfill. Now we would sell stock positions and refill into the short-term bond position to kind of reset, call it a piggy bank, if you will.
Sure. So that's another question that someone had asked relevant to this. So if you did sell in that exact scenario, if you did sell the stocks and the market was down, you are now locking in a permanent paper loss. It's not just a theoretical loss. The stocks are down. Once you sell, they are done. So in this strategy, you sell the stock or the bonds, which have a cash equivalent to some degree.
Short-term bonds.
Sure.
Short-term long-term bonds will have their own volatility, but it's usually going to be settled faster than, let's say, the stock. So going back to something, and I should have mentioned it, in a really drawn out, let's say it's a 10-year recovery. Had maybe 1 or 2 of those in the last 100 years. But once we consume the short-term bond part of the portfolio, most likely we could shift to the long-term bond part of the portfolio. It would not still be down by as much as the stock. So we've actually got like a safety net behind the safety net. We're going to do everything we can to avoid, as you said, if stocks go down 20, we have every belief, if you're broadly diversified, okay, that it will come back 20%. So what you don't want to do is it's down 20, sell, and then those stocks go back up 20%.
Sure.
Because you just took a 20% paper loss, which if you waited long enough would be no loss at all, and you've made it a real loss. You took money out of the stock market goes back up, you don't get the 20%. That's the disaster to avoid.
Okay. So in closing, what general advice would you give someone right now who's watching news, seeing the news talk about, job losses, impending recession? What news would you give someone other than hire a fiduciary financial advisor?
Well, I probably would give that advice. But look, if you can work it out yourself, that's fine. What's important is to know where you are, know where you need to go. And that end date can't just be retirement. It has to be through retirement by some reasonable number of years. You've got to know what it's going to take. What rate of return does it take in order to get through to the end point? Okay. You then have to have a way of assessing, well, how much volatility do I need to undertake in order to achieve that rate of return? And be comfortable with that. Because if you're not comfortable with that, it won't last. We always build portfolios that are mathematically, economically, statistically, if you will, sustainable. I can prove that they're going to work. That doesn't mean that they are emotionally sustainable. Most people make their mistake, in a certain sense, in the very, very beginning. They impose upon themselves greater downside risk than they can emotionally tolerate. They just don't know it. They go, I'm going to be 80% stock. And maybe that works. Maybe all they need is 20% in bonds in order to mathematically, economically, cash flow wise, sustain their living standard through retirement. So that would have worked. But if they can't see 80% of their portfolio, and I mean emotionally see it, go down maybe 20 or 30%, they're going to hit that bottom. They're going to be calling me up or whoever they're using or themselves and kicking themselves in the tuchus and saying, what a stupid mistake I made. Got to get out, got to get out. So they're now making a decision, but the mistake was early on in not judging the emotional component, the emotional sustainability, along with the economic one. Once you've got that figured out, now you need to be broadly diversified in large cap growth, in large cap value, small cap, international stock, real estate, short-term, long-term bonds, and then basically money market. At the very least, that should be 8 investment categories. And I don't mean pick 1 or 2 stocks here, 1 or 2 stocks here. You absolutely need to have professional money management, whether it's an index fund or it's an active manager. There needs to be some guy or gal, professional money manager. They have that title, they have that training, they have that experience. I think we've even done a video on it, where they will pick those individual stocks for you based on disciplined methodology and all the analytical research that they can muster. You can invest with them by buying into the fund they have, whether, again, it's an index fund or it's a passive fund. I mean, an index fund or an active fund. You're now broadly diversified. You've matched risk tolerance with the return that you need. You're not invested in 1 or 2 stocks. You've got a professional that's managing that for you, and you're going to be able to withstand almost anything that's going to get thrown at you. That has to get done. If you can do it, tip my hat to you. Most people can't. So absolutely recommend that you go with an advisor and you threw the word fiduciary in there, because you don't want someone that's got the title of advisor when in fact what it is a wolf in sheep's clothing, where it's basically an excuse to sell your product. Here's my advice. Buy this mutual fund, which happens to pay me 8% or 3% or 5% or whatever they're paying these days in commission. Get someone who's going to charge you a fee for the advice and the counsel, helping you get from point A to point B, unrelated to what you actually invest in. It's kind of like going to a CPA or an attorney. You're paying for the fact that they're giving advice, not for one piece of advice versus another. The lawyer doesn't charge you more because he gave that advice versus this advice. He's going to charge you the advice he gave, whatever it is the one that fits your situation. Get that advice. That's important.
So if anyone out there wants fiduciary advice or has questions about anything happening right now in the news, feel free to go to our website. We'll link it below. There you can schedule a meeting with a fiduciary financial advisor. Complimentary, of course. We don't charge for the first meeting. And we'd be happy to answer any questions as well if you guys have any.
Yeah. Meanwhile, don't worry.
Yeah, don't worry.
Don't worry.